We are taught a very simple rule about economics. When inflation strikes and paper currency loses its value, you buy gold. It is the oldest and safest way to preserve your wealth. The math seems incredibly straightforward. If inflation drives up the cost of living, making it cost twice as much to fill up your car with gas, the value of your gold should theoretically double right along with it, protecting your living standard. Driven by this traditional belief, everyday people react to economic fear by rushing to gold shops. They frantically try to convert their cash into physical metal before everyday prices rise any further. But right now, a massive market anomaly is unfolding. At the exact moment retail investors queue up in a panic, major international funds and large-scale domestic investors quietly prepare to liquidate their holdings. The smart money is abandoning the world's oldest safe haven. A hidden macroeconomic shift is breaking the traditional rules of investing, and the people hoarding physical gold are about to be caught entirely off guard. To see why the pros are selling, look at this diagram. During monetary inflation, central banks print excess money. As paper currency multiplies, it loses purchasing power, forcing gold prices up. However, today's crisis is driven entirely by cost-push inflation. Cost-push inflation operates differently. Prices aren't surging because there is too much cash in the system. They are surging because the raw materials, fuel, and transportation required to manufacture everyday goods have suddenly become vastly more expensive to secure. To prevent total economic collapse from these soaring production costs, central banks have a panic response. They stop printing money completely, and institutions like the European Central Bank aggressively raise interest rates to cool down the broader market. This specific shift from printing money to aggressively hiking interest rates completely flips the script. It abruptly transforms gold from a protective economic shield into a severe financial liability for large-scale investors. Consider how this affects international ETF funds. An ETF, or exchange-traded fund, is an investment vehicle that trades on stock exchanges, much like regular stocks. Previously, these massive funds leveraged cheap, low-interest debt to purchase huge quantities of gold and generate high returns. This chart illustrates the trap they are caught in. As central banks spike borrowing costs, that red line shoots up and overtakes their declining gold yields. These funds are suddenly bleeding cash, forcing them to sell gold reserves to service their massive, expensive debt. We see the exact same squeeze playing locally. Domestic whales, professional investors holding massive physical gold reserves, often operate large real estate portfolios and active businesses. These investors are currently trapped in a vice. The combination of skyrocketing supply chain costs and a frozen real estate market paralyzed by high borrowing rates has completely eradicated their day-to-day business cash flow. For both the global fund manager trading on screens and the local business tycoon staring at an empty construction site, survival in a high-interest environment requires immediate cash. They are forced to liquidate their most highly valued asset just to keep the lights on. There is a persistent retail myth that gold prices cannot crash domestically. Everyday buyers assume that local gold shops will simply refuse to lower their selling rates, artificially keeping prices high despite what happens globally. The structural reality of the market tells a different story. Gold shops are merely middlemen. They facilitate trades and maintain market liquidity, but they do not dictate the metal's actual value. Imagine the impending market shock when multiple domestic business whales are forced to act. They will simultaneously offload hundreds of taels of physical gold to avoid bankruptcy and pay down their suffocating bank loans. Here is what that looks like on a supply and demand curve. When that massive influx of physical supply drops onto the counter, shop owners will instantly slash both their buying and selling prices. They have to avoid being trapped holding rapidly depreciating inventory. In an era defined by cost-push inflation and punishing interest rates, cash flow dictates survival. When the pressure peaks, absolutely no asset, not even gold, is immune to the gravity of macroeconomic forces.